Analyzing statement of cash flows part 2. Here we're going to look at how to analyze cash flow statements in terms of where is a company getting its cash from, what are the sources of its cash, and how is it using that cash. We will also be discussing why it's important to evaluate the sources and uses of a company's cash flows. Secondly, we'll move on to the tools that we use to achieve the above objective. So, how do we go about evaluating the sources and uses? We use common size analysis and we also use ratios. Then we will talk about free cash flow measures, that the cash that is being generated by the companies, how much of that is available for the entire firm. So free cash flow, FCFF, free cash flow to firm, and free cash flow to equity providers, FCFE. So the one for equity providers is obviously for equity investments. If you're making an equity investment, you will be interested in the free cash flow that the company is generating, which is available for the providers of equity. And free cash flow to the firm is, of course, relevant for providers of debt as well, because this is not only for providers of equity, this is for the entire firm. And as you know, providers of debt get a priority in terms of their interest payment and principal repayment before equity holders can get paid. And then finally, we'll look at some of the cash flow ratios analysis. So as discussed, we'll be getting into evaluating the sources and uses of cash. So this is kind of like the why, and common size analysis is the how, which means how do you do the analysis. But more importantly than the how is the why you need to do it, why it's important to evaluate the sources of a company's cash flows and how it is using that cash. And then we will get into the formulas for FCFF and FCFE. And then finally, we will look at some ratios of cash flow. Okay, so here is the why. Why do you need to analyze this? The answer is that, first of all, it will help you establish at what stage of its growth is the company currently at. For mature companies, your operating activities are usually churning out a lot of stable cash flows, right? So hence, for them, it's going to be a primary source of cash, your cash flow from operating activities. For startups, usually what you see is cash flow from financing activities is where the money is coming in from, and either equity holders or even loans are coming in so that the startup can get on its feet. So as a provider of capital, we need to be very careful to analyze what is the current status of this company, what stage of growth is it at, and even more importantly than that, the cash flows that it is generating, whether they're coming from operating cash flow or financing cash flow. So whatever the source is, the question is, how is it being used? Does it cover the uses? So for example, capital expenditure relates to your cash flow from investing activities, where sometimes you have to buy new equipment, sometimes you have to buy new land. And that's okay if you're a growing company, but if you're a mature company, then you just have to maintain your existing property, plant, and equipment. And the point is, do you have enough cash flow being generated from your operating activities for maintenance of your property, plant, and equipment? So what we see is, okay, what is the level of depreciation that is happening in their existing infrastructure, and is the cash that they are generating from their operating activities enough to cover that depreciation so that they can maintain their infrastructure, their production infrastructure. Otherwise, the company is not going to be able to survive. So, what we want to see is, number one, what are the sources, right? And number two, are they enough for the users? Secondly, what we want to check is the level of accrual, the amount of accrual. Now, what does that mean? See, you already know from previous learning modules that you can record sales, you can record revenue if the rules of sale have been completed, right? Revenue recognition has certain rules. If you complete them, even though cash might not have been received, you can record it. If, for example, there is a company which is recording a lot of revenue, but there's not enough cash coming in, then that is not a good sign, because it might mean that they are doing a lot of aggressive revenue recognition, and as an analyst we don't like that. So that's why it's good to compare that how much operating cash flow is there within net income, and this is a ratio we will be talking about towards the end of this learning module, and I will give you a very practical example from my experience. But let's discuss that when we get to the ratio part. However, obviously, if there is a poor operating cash flow but the net income is large, then that is definitely a red flag, because it is a sign of poor earnings quality. And when we talk about earnings quality or reporting quality, it is not that the quality of the product is bad that the company is producing, or the quality of the service is bad that the company is selling. It is the quality of the financial reporting, that they are having accounting practices which are of not very good quality, right? The earnings quality is poor. The net income that they are showing, it is not of very good quality. And then lastly, what the analyst should look into is the consistency of operating cash flows, that it should be consistent with your income, it should be consistent with your revenue, not that your revenue is stable and growing, your income is stable and growing, and then your cash flows are completely unstable. So that, of course, would be another red flag. Next, we need to move on to the uses of cash, right? That if you're, let's say, from your cash flow from investing activities, that are you investing in property, plant, and equipment? How much is of your cash flow from operating activities is being used for cash flow from investing activities? And is that covering the depreciation of your property, plant, and equipment? Or is it because you're just saving for a rainy day by investing in some liquid investments? So obviously this is a good thing, because if the company has a lot of positive cash flow from operations and it is setting aside that positive cash flow in long-term investments, that of course is a very good thing. But if majority of that money is just going to maintain and upgrade and just keep in running condition your property, plant, and equipment, then that is a little worrying, because what we want to see as an analyst is that the cash flow from operations, is it enough to maintain the property, plant, and equipment, right? Because if it is not, then that means the company is not going to be able to sustain its operations. Unless it borrows money, and a mature company should not be borrowing money, rather it should be repaying the capital that they borrowed when they were in the growth stage. I mean, if it's a growing company, of course, it's okay that if they're raising capital. So that's why, to start off with, we need to identify what stage the company is in. And if it's in a mature phase and it's still not repaying capital, rather it's still struggling and trying to raise capital, then definitely we will not be very inclined towards investing in this company, right? So that was the why. That why you need to analyze your sources of cash and uses of cash. Now let's get into the how, and we're going to talk about common size analysis first, and there are two approaches over here. In the first approach, we take all items that are mentioned in your cash flow statement we separate them into inflows and outflows, and the inflows we see as a percentage of inflows and the outflows we see as a percentage of outflows. Now you might remember from your balance sheet, we were looking at every item as a percentage of total assets, whereas in your income statement, we were looking at it as a percentage of your revenue, right? So here, in cash flow statement, we're going to be looking at two types of common size analysis. One is each inflow as a percentage of inflow and each outflow as a percentage of total outflow. The second approach is that we take each of these items from cash flow from operating, investing, and financing activities, and we look at it in terms of as a percentage of total revenue, right? So this is obviously similar to the common size analysis that we do for income statement, that there also we are looking at all the items as a percentage of sales. Now, which of these two methods is better? So the first one, which is looking at it in terms of a percentage of outflows and inflows respectively, it helps us to see the trends in cash flow, right? Rather than seeing the whole amount, that okay, what are the sources of inflow and what are the uses of outflow. In percentage terms, you can see, okay, my sources are coming in 80% from, let's say, cash flow from operations from customers, and my uses are 80% is going in cash flow from investing, and within that it is going in depreciation. So when you see as a percentage of inflow and a percentage of outflow, you're really able to identify the trends in your sources and uses, right? And the second one, which is as a percentage of revenue, is very useful in forecasting future cash flows, because obviously when you will do the projections, you'll start with the income statement. You're going to start by projecting your revenue, and based on that you can project your balance sheet as well and your cash flow statement as well. Which brings me to measures of free cash flow, because in the very beginning of this discussion on cash flow, in the previous learning module, because of course cash flow analysis has two learning modules, and in the previous one, which was the first learning module for cash flow analysis, I told you how important free cash flow to equity is, because from an equity valuation perspective, when you're valuing a stock, it depends on the present value of future cash flows, right? And that future cash flows is not cash flow from operations. It is, for equities, it is cash flow, it is free cash flow for equity providers. But before I move on to free cash flow for equity providers, let me discuss free cash flow to the firm. And this is what you need to project into the future, right? And then FCFE is what you need to project into the future, and then you can get into equity valuation. And this is something you're going to learn to appreciate over the next 3 levels of your CFA studies. Very, very important, very, very fundamental concept for your valuation. Now, let's discuss FCFF first. Now, FCFF is free cash flow to the entire firm, right? And the firm obviously has two major providers of capital, the providers of debt and the providers of equity. Later, we're going to look at only the free cash flow for equity, but first we're looking at free cash flow to the entire firm, which is cash available for both your providers of debt and your providers of equity. Now, how do we go about coming up with this figure? First of all, you take the cash flow from operations, right? And if from the previous learning module you remember the indirect method of preparing cash flow from operations, what was that? You take the net income, you adjust the non-cash charges, and you adjust all the changes in your balance sheet operating accounts. Now, what was that? It was, for example, if your accounts receivable was going up, that means you're supplying goods to your customers but not taking money from them yet. So it's like a investment, working capital investment that you're doing. Or if your inventory is going up, which is your asset as well, that means you're investing in inventory but you're not getting cash right now. So that of course is an investment in terms of your working capital, but your cash flow will be going down. So increase of these balance sheet operating accounts means your cash flow is going down, hence the negative sign over here. And going up of liabilities such as accounts payable going up, which means you've received goods from your suppliers but you haven't paid for them, so this is a good thing, right? Unearned revenue going up, which means you've received cash from your customers but you haven't supplied them the goods and services, so that obviously is positive. And this is something we've discussed previously, that liabilities going up is good for the cash and assets going up is bad for the cash and vice versa. But overall, whatever is the working capital investment, that has to be subtracted, because if you're investing in working capital such as inventory or account receivable, that will be subtracted, whereas if you are getting cash from your accounts payable or your unearned revenue, that will be added. So you take your cash flow from operating activities and then you make two adjustments to it. Number one, you add back the interest net of tax. Why? See, because we are looking at the cash flow to the entire firm, which includes the providers of debt. So interest is obviously going to be paid to these providers of debt, right? So we just add that back so that we are able to calculate the free cash flow that the entire firm is generating for both these stakeholders before any of them is paid, right? Before any of them is paid. So what we do is we add back the interest net of tax, naturally, because obviously the tax benefit was already there in the income, in the net income. So that is why we added back net of tax, and we minus fixed capital investment. Why? Because this is something that is mandatory for the company to do to maintain their property, plant and equipment if they are to continue in business. So this money is not available for the providers of debt or the providers of equity. This is something the firm needs, the business needs to continue its life, right? So this cash we have to set aside, and this obviously is going to be coming from your cash flow from investing activities, that this is money that is needed for maintenance of the company's property, plant and equipment, and this will be subtracted before you can come to the cash flow that is available for the providers of both debt and equity. And that's the formula that you see over here, where instead of writing net income plus non-cash charges minus your investment in working capital, right, we've just written CFO directly. Now CFCFE. So you're starting with CFO, you're not adding back the interest. Why? Because when we were calculating FCFF, that was free cash flow to the entire firm, which included providers of debt. But now we are calculating FCFE, so we will not add back the interest over here because that interest has already been paid, assumed to be paid to the providers of debt, and then whatever is left providers for the providers of equity is what we are calculating. So hence we are not adding back the interest over here. However, we still do subtract the money required for your fixed capital, property, plant and equipment maintenance, because that is a requirement for the business to continue, and we add any new borrowing, right? So if you're getting new loans from the providers of debt, that money is available to the providers of equity. And this is such a powerful concept, because what I've seen is, and some of you might already be aware of this, private equity firms, what they do is they buy a company and they will use their own money to buy a company. Then what they can do is they can get a loan, right? They can get debt financing for this company and they can pay back part of their original equity investment. So they take out their money by getting the company a loan. And why they're able to do that? Because obviously they fix up the company and they have a good reputation as well. So the net borrowing that is there from new debt is actually money which is available to the providers of equity. Right, now moving on to the cash flow analysis. Here we're going to talk about two types of ratios, profitability and solvency ratios. First of all, the profitability one, and I'll tell you a practical example from my experience. So I used to be working for a company that was providing high-tech equipment on lease of 5 years to very large corporate clients. So 5 year lease. But it would first buy on cash the equipment, right? It would buy on cash this high-tech equipment, and then it would lease it out to corporate customers for 5 years. And the business was growing. So a lot of cash outflow was there because they were buying a lot of expensive equipment on cash, but they were not getting that cash because the sales was being broken up into 5 years. So what was happening is that every year we had this negative cash flow from operating activities, and we had overall a net negative cash flow in business. And the bankers that were giving us the loans, and the shareholders, the providers of equity that were providing us equity capital, they were all just concerned that why is your cash flow consistently negative? I mean, you're showing very high sales because of course your projects are growing, you've got these customers who are leasing this equipment from you, but your cash flow is negative. So then we had to explain to them that we are currently in a growth stage, and therefore, we are investing and buying. So our working capital is going up, and therefore, the cash flow as a percentage of revenue is very low. But then the story has to be there. And as an analyst, if you are investing in a company or you're analyzing a company, whether to recommend debt investment in it or equity investment in it, right, you have to be sure that if any of these sources, any of these ratios are low, right, which means cash is low, then there needs to be a justification for that, whether it is cash flow from operations compared to net revenue or total assets or just the equity or the operating income, which is your EBIT, right, or the cash flow per share, where instead of net income we take cash flow from operating activities. So this is a similar formula that you have seen before: net income minus preferred dividend divided by the number of shares. This is the formula for earning per share, right? But we're not doing earning per share, we're doing cash flow per share. Therefore, it's cash flow from operations minus preferred dividends divided by number of common shares outstanding. The point is, if you're looking to do an equity investment, or your client is and you're doing the analysis for them, if these profitability or performance ratios are low in your cash flow analysis, there needs to be a justification for that. Similarly, if you look at the coverage ratios, and this is more relevant for those analysts that are analyzing a company for providing debt capital to it, is that will they be able to pay their interest on time? So what is the interest coverage? Right, what was the cash they generated? And we know that we already subtract the interest when calculating cash flow from operations, so we added back here. We also add back the taxes paid, because we want to come to that amount, that what is the cash the business generated before it paid interest, before it paid taxes, divided by what is the interest it has to pay. So we just want to see how many times it is able to generate cash, right, compared to what is the interest it has to pay. So if it has to pay $1 of interest, is it generating $5, right? So that obviously is a comfortable situation, and they definitely have a high ability to meet their interest obligations in the short term, right? And what about their long term? So that's the first one, which tells us, okay, what's their total debt? Not just the interest paid right now, but what is their total debt, and what is the CFO as a percentage of the total debt? Or what is their ability to maintain their long-term assets, right? So how much money they are paying to maintain their long-term assets, and what is the cash flow generating ability, right? Similarly, for long-term debt, this is linked to your debt coverage as well, that what is the amount of money you're paying for long-term debt repayment, not interest, the repayment portion, and how much is the cash flow you're generating. Then in terms of, is it enough for your equity providers? So what are you paying to them in terms of their dividends, and what is your ability of generating cash? And then lastly, of course, compared to your investing and financing. So ability to acquire assets or pay debts and make distribution to owners. So everything comes together in your investing and financing activities, where you're comparing your CFO to your CFI and CFF. So that is it for this very interesting learning module. Let's have a look at the summary. We talked about what are the sources of cash, what are the uses of cash, and we really want to make sure that the earnings quality, right? Earnings quality is good, because if your net income is very substantially, materially different from your cash flow generation, then that means that there is aggressive accounting policies being followed, right? And we don't like that as analysts. Secondly, we also want to make sure that the cash that you are generating is enough for your sustainability of your business, right? We don't want you to be selling your assets to maintain your business. It should be sustained by cash flow which is generated from operating activities, and that is sustainable. But if it is not the case, then that means your business is not able to sustain itself. Next, we looked at cash flows from investing activities, where we said, okay, what's happening with your property, plant, and equipment? Is it increasing or is it decreasing? So decreasing outflows obviously means that growth is going down, which is not necessarily a bad thing. A company stabilizing is a good thing for those type of investors that are looking to invest in stable companies. But then CFO should be enough to then pay for this level of outflow now. And if it is increasing, then clearly it is growing. But the point is the company able to finance that growth, right? Where is it getting that money? Is it getting new loans or new stocks, right? And then will they be able to pay back all of these loans and stocks? So this is the whole big picture, that we have to analyze the sources and the uses. And how do we go about doing this? So for the sources and uses, you take the entire inflows and see as a percentage of inflows, and you take the entire outflows and see as a percentage of outflows. So you understand where it's coming from and where it's going, right? Which is the major source of inflow and which is the major source of outflow. And this is good for identifying trends. But if you want to do the projections, definitely the other method, which is percentage of revenue, is very useful. And we do have to do projections because we have to come up with FCFF and FCFE. FCFF to value the firm from a debt investment perspective, and FCFE to value the equity portion of the firm only. And finally, we looked at different types of ratios, where we take our cash flow as a percentage of either revenue or assets or equity or income or per share, to get an understanding of what is the performance of the company and what is the coverage ratios in terms of its ability to pay its interest on time, to maintain its long-term assets, to pay back their long-term borrowing, and to pay their equity holders on time, and not only equity holders and debt holders, but also maintain their equipment. So that is it for this learning module. Hope you enjoyed both the cash flows and the income statement and the balance sheet modules. Very, very important ones. As always, you have to focus on the end of reading questions as well from your curriculum. These three are very, very important. Four rather, because cash flow has two. So your income statement, balance sheet, and then the two learning modules of cash flow are important for your level 1 exam.